Welcome to This Explainer. Okay, I want you to picture something I think we can all relate to. You finally decided to do the responsible thing, right? You start putting money away every single month, $100 here, $200 there. You're feeling incredibly disciplined, super financially mature. But then, you open up your banking app and that sinking feeling just hits you. You realize this incredibly frustrating truth. Your hard-earned money isn't actually growing. You keep hearing everybody talk about compounding and building wealth, but you're just sitting there staring at a static number. Well, today we're going to fix that by walking through the exact step-by-step path from simply saving to actually investing.
Let's look at the actual kind of painful math behind typical savings accounts. Say you've got $10,000 just sitting there, and it's earning what? A measly 0.5% interest? Do you know what that actually means in the real world? It means after leaving your money locked up for an entire year, you've made a grand total of $50. Yep, $50. It totally validates that sneaking suspicion you've always had. Saving money is a fantastic habit, absolutely, but saving alone is almost never going to build you real wealth. It's just the starting line, guys, not the finish line.
So the crucial thing we need to get straight right off the bat is the fundamental difference in what these two financial tools are actually hired to do. They have two entirely different jobs. Savings, that acts as your shield. It protects your money from just disappearing. But investments act as the engine. They're what actually propel your money forward and grow it over time. Think about it. If you only ever use a shield, you're never going to move forward. You absolutely need that engine to get you to your ultimate financial destination.
Now, to really see why this matters, let's zoom out and look at the math over a 20-year timeline, using that exact same $10,000. If you leave it sitting in savings earning around 1%, after 2 decades, you're looking at maybe $12,200. But if you take that exact same starting amount and put it in an investment like the S&P 500, which historically averages around a 10% return over long periods, it explodes to a massive $67,000. I mean, that is the staggering wealth gap that compounding creates. Same starting money, entirely different life outcome.
So you're probably wondering, if the math is that obvious, why do so many people get stuck? Well, it all comes down to this incredibly powerful psychological trap. We all have this deep-rooted belief that saving feels incredibly safe, but investing feels risky. And hey, it makes total sense. When your money sits in a savings account, it doesn't fluctuate. It's not going to suddenly drop 5% on a random Tuesday. But the stock market, it bounces up and down, and that emotional roller coaster absolutely terrifies people away from building wealth.
All right, let's get into the solution. Here is part 1, the 5-step investing path, where we're going to move you straight from anxiety to empowerment.
We're going to walk through this exact stress-free framework sequentially. First up, the emergency fund. Then, mental separation. Third, starting small. Fourth, simple investments. And finally, consistency. Let's break down that very first step.
Step 1 is absolutely non-negotiable. You have to build a real emergency fund. Before you even think about putting a single dollar into the market, you need 3 to 6 months of living expenses safely tucked away in cash. Why? Because an emergency fund protects your investments from your own life. When the sudden car repairs hit, or those unexpected medical bills pop up, and trust me, they always do, you won't be forced to panic sell your investments at a major loss just to make rent. Which leads us perfectly into step 2, which is really a brilliant psychological trick. You need to mentally separate your money into 2 completely different buckets. Bucket 1, that's your safety money. It stays static, it stays safe, that is your emergency fund. But bucket 2 is your growth money. Because its entire job is to grow and compound over decades, it's allowed to fluctuate. Making this clear mental separation dramatically lowers your daily anxiety when the market drops, because you know for a fact your safety money is completely untouched.
Okay, steps 3 and 4. Step 3 is simply to start small. You don't need thousands of dollars to begin. Literally $50 is enough to just build the habit. Step 4 is to use simple investments. Please do not make the beginner mistake of jumping into stressful day trading or crypto speculation. Simple, boring index funds easily beat out those complicated strategies over time. They effortlessly track the overall market, they give you massive diversification, which lowers your risk, and honestly, they are literally the exact strategy recommended by Warren Buffett. Keep it simple.
And here is where the magic really happens. Step 5, consistent investing. This chart blows my mind every single time. If you consistently invest just $300 a month over 25 years at an average 8% return, you end up with roughly $285,000. But look at this. You only contributed $90,000 from your own pocket. Almost $195,000 of that total comes entirely from compounding growth. That is literally your money working for you while you sleep.
All right, let's move into part 2, surviving market volatility. We really need to talk about thinking in decades, not days.
Look, market downturns are the #1 thing that terrifies beginners, but we need to completely reframe this fear in your mind. Because yes, eventually the market will dip, and your app will show scary red numbers. Crashes are normal. They happen all the time historically. But here's the ultimate secret. For long-term investors, a crash is actually a massive buying opportunity. When the market drops, your consistent monthly contributions are just buying more shares at heavily discounted prices. You're literally buying stock market assets on sale, which sets you up for explosive returns when things inevitably recover. To really lock this in, I love this simple analogy. Saving your money is exactly like storing seeds in a sterile glass jar on a shelf. Yes, you're protecting them, and sure, they are perfectly safe, but absolutely nothing is ever going to grow in there. Investing, on the other hand, is taking those exact same seeds and planting them in the dirt. Yeah, at first it looks messy, you don't see results right away, but you give it time, let nature do its thing, and ultimately it creates massive, life-changing growth.
So, bringing all of this together for the core takeaway of this explainer, these two concepts have to work as a team. Saving money equals stability. It gives you that emergency fund, lets you sleep peacefully at night, and shields you from absolute disaster. But investing? Investing is the engine that actually builds your wealth. Investing equals freedom. You absolutely need the stability first so you can confidently go out and pursue the freedom second. So I'm going to leave you with this final question. The next time you open up your banking app and stare at that savings balance, I want you to ask yourself, are you just storing your seeds in a sterile little jar where they're never going to grow? Or are you finally ready to walk this step-by-step path, embrace a little bit of the messy dirt, and start planting them for your future? The choice is entirely up to you.